We hear a ton about massive e-commerce storefronts and global marketplaces. They get all the headlines. But the physical movement of goods, the actual supply chain magic that gets a package from a warehouse shelf to your front door, that is where the real revolution is happening right now. And sitting right at the absolute center of this revolution is a deeply fascinating tech company called Shiprocket. We're going to dive into the hidden logistics engine that is quietly powering the digital economy. So let's start with a question you've probably wondered at some point. How exactly does a small, independent Instagram seller, someone maybe packing orders out of their living room or a tiny local warehouse, how do they manage to ship their products with the exact same speed, tracking, and reliability as a behemoth like Amazon? Keep that question in the back of your mind because the answer reveals this massive, largely invisible gap between enterprise conglomerates and everyday micro, small, and medium businesses. Okay, to really understand the solution here, we have to travel back to the absolute chaos of early Indian e-commerce in the 2010s. Back then, building a digital storefront was actually getting pretty easy. Anyone could throw up a slick-looking website. But physically moving a box from point A to point B, it's hard to overstate just how much of a complete and utter nightmare it was. What's wild about this era is how the entire system was fundamentally rigged against the underdog. If you were a small seller moving, say, just 10 to 50 orders a day, legacy carriers actively penalized you. They demanded these huge minimum volume guarantees. You had zero negotiating power, which meant you were paying premium rack rates that just destroyed your unit economics before you even had a chance to scale. And on top of that, regional coverage was totally fragmented. It all boils down to one absolutely brutal number: 30%. This was the crippling return to origin or RTO rate plaguing the industry. Driven mostly by failed cash-on-delivery orders, this was literally the single biggest margin killer in e-commerce. Sellers were forced to eat the forward shipping costs, the return shipping costs, and they lost time that inventory could have been sold to someone else. It was bleeding them dry. And compounding that financial drain was a geographic reality. India has over 24,000 PIN codes. At the time, absolutely no single courier could reliably cover that entire map. This forced small sellers into these manual, super chaotic relationships with 4 or 5 different delivery partners just to get national coverage. Just imagine having to manage 5 different dashboards and dispatch protocols by hand, every single day. Enter the founders Sahil Goyal, Gautam Kapoor, and Vishesh Khurana. Now, their journey didn't actually begin with shipping. Back in 2011, they founded a company that eventually launched Shiprocket. This was a DIY website builder meant to help small merchants get online. But by 2014, after acquiring thousands of customers and finally starting to scale, they had this massive realization. They were slamming headfirst into the physical realities of their customers' biggest bottleneck: shipping. Their origin story is incredibly gritty. They were as grassroots as it gets. Co-founder Sahil Goyal said something that really shows their hustle. "We bootstrapped our company, sold services for the first year or so to make salaries for our engineers to build the product." They were right in the trenches with these merchants, which allowed them to see firsthand a multi-billion-dollar problem that was hiding in plain sight. They realized they were essentially solving the wrong problem in a highly crowded software vertical. Look, the world already had plenty of storefront builders. Shopify and others were absolutely dominating that space. But the physical execution layer of logistics in India, that was completely, hopelessly broken. And this leads us to what is easily the climax of their early story, the 2017 unbundling. The founders made an incredibly bold, counterintuitive pivot. They literally conceded the digital storefront layer to the global giants, stripped out their own internal shipping module, heavily upgraded it, and launched it as a standalone logistics aggregator. They named it Shiprocket. Their approach here was radical. Instead of buying trucks or building traditional massive warehouses, they treated the physical movement of vehicles, packages, and inventory strictly as a data problem. Their entire goal was to abstract all that physical, real-world chaos into a clean, predictable API that any small merchant could just plug right into. But, of course, that brings up an immense technical hurdle. How in the world do you build an artificial brain capable of orchestrating millions of packages across dozens of third-party couriers, all in real time, when you don't even own the trucks yourself? Their brilliantly engineered solution was Crore, the courier recommendation engine. This is an AI-powered tool that dynamically matches every single order with the perfect courier. It analyzes PIN code level data in real time, perfectly balancing speed, cost, and historical courier performance to route the package optimally. So here is the frictionless magic that happens the second a merchant clicks ship. Step 1. The order is uploaded automatically right from the seller's website. Step 2. The AI instantly analyzes all the constraints: weight, destination, cash on delivery requirements. Step 3. It automatically dispatches the order to the absolute best courier partner. What used to take hours of manual paperwork literally now takes milliseconds. To truly grasp the scale of this automation, consider this. Today, a staggering 96% of all merchant onboarding is handled entirely by this automated engine. Zero human intervention. It's essentially a fully self-serve logistics powerhouse. The contrast is literally night and day. The old way meant manual paperwork, juggling 5 different career dashboards, and paying those exorbitant rack rates. The Shiprocket way means one single unified AI dashboard and access to heavily discounted, pre-negotiated bulk rates that used to be reserved exclusively for enterprise giants. And hey, remember that 30% margin killer we talked about earlier? By utilizing data-driven address verification and automated non-delivery report management, Shiprocket effectively sliced the industry's biggest nightmare right in half, bringing the RTO rate for their merchants down to around 15%. That is pure bottom-line profit handed straight back to small businesses. But the craziest part? They didn't stop at just shipping. This foundational tech allowed them to build something so much larger. Shiprocket evolved from a simple shipping aggregator into a massive, sprawling e-commerce operating system. They realized that once you control the logistics data, you can build the entire digital infrastructure for commerce. They rapidly built out an expansive, modular tech stack that is honestly wild to look at. We're talking Shiprocket Fulfillment for warehousing, Shiprocket Quick for local deliveries, faster checkout to prevent cart abandonment, Shiprocket Capital for revenue-based financing, and Shiprocket Cargo for heavy freight. They became a complete end-to-end enablement platform. Let's actually zoom in on a few of these, starting with Shiprocket Quick. This is their hyper-local integration with delivery networks like Dunzo and Porter. It acts as an absolute lifeline for local offline merchants. It allows a mom-and-pop neighborhood store to suddenly offer sub-60-minute deliveries and effectively compete in the fierce instant commerce wars. Then there's Faster. This is their AI-native pre-order suite, and the scale here is insane. It holds behavioral and address data on over 155 million end consumers. When a buyer hits checkout on a merchant site, the AI pre-populates their address and preferences, which practically eliminates cart abandonment and massively boosts conversion rates for the seller. And moving further up the supply chain, they launched Shiprocket Cargo. This abstracts the incredibly heavy, complex logistics required for B2B bulk inventory. So if a brand needs to move a ton of inventory into massive marketplace warehouses or quick commerce dark stores, Cargo comes in and orchestrates the whole thing. The operational metrics here really prove that their data-first approach works just as flawlessly for heavy freight as it does for small parcels. Early pilots showed a 98% on-time adherence rate, a 10% drop in warehouse rejection rates, and it saved merchants anywhere from 24 to 48 hours in transit times. That's a huge operational advantage. Because of this sprawling, highly intelligent ecosystem, Shiprocket now successfully reaches over 29,000 PIN codes across India. They have totally neutralized that geographic fragmentation problem that used to completely paralyze independent sellers. But this naturally begs another really interesting question. Once you've conquered the domestic market, what happens when a local homegrown brand wants to go global and sell to the world? That exact ambition birthed Shiprocket X. Guided by co-founder Akshay Gulati, this product is the ultimate leveling of the global playing field. The entire goal of Shiprocket X is to make the immense friction of cross-border trade virtually invisible to a small business owner. It takes the terrifying complexity of international shipping and distills it down into just a few clicks. Sellers get completely transparent selection between ocean and air freight, the platform automates all the complex export documentation, and it ensures seamless customs clearance, navigating those dense international regulations entirely in the background. The result of this is profound. Think about it. An independent artisan sitting in a Tier 3 city in India can now instantly and reliably ship their products to over 220 countries and territories worldwide with the exact same ease as shipping to the next town over. And to ground all this high-level tech in reality, listen to this from an independent merchant called The Pouring Affair. Partnering with Shiprocket X has been a game changer. Our products now reach our customers faster and in pristine condition. This isn't just a piece of software, it physically transforms how small businesses operate and survive on the global stage. Now, perhaps the most fascinating strategic reality of this entire story is their asset-light model. Shiprocket achieved this massive, nation-spanning and global logistics network without owning huge fleets of delivery trucks or cargo planes. They act purely as the intelligent orchestrator, the central nervous system connecting demand with supply. And because they are asset-light and heavily data-driven, their impact is felt most profoundly outside the major hubs. 66% of their delivery footprint is in Tier 2 and Tier 3 cities, compared to just 34% in metro hubs. The true power of this platform is that it is actively decentralizing commerce, moving it away from major metropolitan centers and fiercely empowering the long-tail economy. So when you look back, why did they win? Well, they had the courage to unbundle the core problem, pivoting away from a super crowded software market. They treated physical logistics as pure data. They built a highly scalable asset-light ecosystem. And above all, they successfully democratized enterprise-grade tools for the ultimate underdogs, the small businesses. Which leaves us with a pretty powerful thought to wrap up on. We've seen how they transformed the fragmented chaos of local logistics into a highly streamlined global engine. When a single digital operating system can orchestrate the logistics for an entire nation's small businesses, what borders will it erase next? It's a fascinating space to watch. Thanks for exploring this massive tech shift with me, and I'll see you next time. We are looking at a platform that currently facilitates $4 billion in annual gross merchandise value across 250,000 merchants, processing over 200 million e-commerce transactions annually. For institutional investors, the narrative surrounding this company has shifted dramatically over the past several quarters. 7 crore rupees. This single figure right here represents that fundamental shift. After years of intensive capital burn just to capture market share, Shiprocket flipped to a positive adjusted cash EBITDA of 7 crore rupees in fiscal year 2025. This establishes the hard-hitting financial baseline of the company's turnaround. They've essentially proven that the core unit economics of their model can actually generate cash, effectively transitioning the narrative from growth at all costs to sustained operational viability. But this brings us to the central tension of this public offering. Can an asset-light aggregator truly build a defensible moat against the very carriers it relies on? It is absolutely the defining question for anyone analyzing the stock. If you don't own the trucks, the warehouses, or the planes, what exactly is protecting your margins? It's a structural vulnerability the market simply cannot ignore. The financial turnaround. To really understand how they reached this critical pre-IPO milestone, we have to look directly beneath the hood at the underlying performance data. Just look at this top-line trajectory juxtaposed with their aggressive cost controls. Operating revenue expanded from roughly 1,315 crore in FY24 to over 2,024 crore in FY26. That maps to a compound annual growth rate of roughly 24%, and concurrently, the net loss profile contracted aggressively. They narrowed their profit before tax loss from a massive 595 crore deficit in FY24 down to roughly 79 crore by FY26. Transitioning from a high-burn logistics tool into a profitable, full-stack commerce OS. Between FY23 and FY24, Shiprocket executed a 48% reduction in cash EBITDA burn. We're talking a drop from 191 crore down to 100 crore before they finally crossed into profitability in FY25. They effectively realized that being a high-burn logistics tool is a tough sell on Dalal Street, and they restructured into a profitable, full-stack commerce operating system. The aggregation arbitrage. The mechanics driving this financial turnaround are rooted deeply in their operational framework and their technological infrastructure. The underlying engine of their business model is the Courier Recommendation Engine, or CORE. It's an AI-powered system processing an astounding 11.7 billion monthly API hits to optimize real-time multi-carrier routing. So rather than relying on static rules, it evaluates destination PIN codes, historical route performance, and pricing in real time. This is Shiprocket's primary technological moat. It essentially democratizes enterprise-grade logistics, allowing small and medium businesses to access optimized shipping networks instantly. Over 145,000 active sellers, more than 25 integrated carrier partners, 24,000 plus serviceable PIN codes, and 620 million unique transactions analyzed. The crucial point here is how this technology scales. By pooling the shipping volume of all those active sellers, Shiprocket acts as a massive demand aggregator. They negotiate Tier 1 enterprise rates with their carriers across a massive geographical footprint. This generates a massive data advantage, allowing them to capture the spread while passing savings directly to the merchants. 82.5%. And that data advantage feeds directly back into loss prevention. Their AI-powered return to origin, or RTO, prediction model achieves an 82.5% accuracy rate. By flagging high-risk buyers before an item is even dispatched, this system actively prevents costly cash-on-delivery failures for merchants, which significantly improves the unit economics on every single transaction. Margin expansion and growth. Now, with the core mechanics stabilized, institutional scrutiny naturally shifts toward the forward-looking margin catalysts that will dictate the company's public market valuation. Core domestic shipping at 80% versus emerging businesses at 20%. Evaluating their revenue streams today, the core domestic shipping business obviously still contributes the lion's share of the total, but it's that remaining 20%, the emerging businesses segment, that requires our closest analytical attention. Look at the velocity of this specific segment. Emerging business revenue jumped from 2,313 million rupees in FY24 to 5,387 million rupees in FY26. That is a staggering 65% year-over-year revenue jump in FY26 alone. This segment is significantly outpacing the legacy core shipping business. Strategic expansion into Shiprocket X, Omni, faster checkout, and capital solutions. This rapid expansion is driven by strategic, higher-margin verticals. They are essentially unbundling e-commerce through cross-border shipping, omni-channel retail, one-click checkout, and merchant financing. These emerging lines are absolutely essential. They are the primary margin catalysts designed to justify the upcoming IPO valuation multiple. And the proof is buried directly in the red herring prospectus. This official key performance indicator table objectively compares Shiprocket's segmented revenues and operations against listed peers like Unicommerce. It clearly delineates the massive jump in that emerging business revenue, moving well past 5 billion rupees. This proves that the thesis of shifting merchants up the value chain into higher-margin software services is actively materializing. IPO structure and valuation. Capitalizing on this growth trajectory, the company has formalized its structural approach to the public markets. Here is the exact architecture of the offering. It's a 1,617.48 crore rupee issue. The capital split is really what's critical here. You have an 885.50 crore fresh issue designed to fund further growth and acquisitions, paired with a 731.98 crore offer for sale, which allows founders and early backers to realize their exits. The price band is tightly set between 92 and 97 rupees per share, with a lot size of 154 shares. August 12th, the subscription opens. August 14th, it closes. Allotment is finalized by August 17th, with a target listing on August 19th. For those tracking the immediate timeline, it is a very narrow subscription window that analysts need to be acutely aware of. $1.2 billion. To properly contextualize this offering, we have to look at their private market history. Shiprocket achieved a historic pre-IPO valuation of $1.2 billion during its extended Series E rounds, backed by heavyweights like Lightrock, Zomato, Temasek, and KD Ventures. Public market investors are now weighing this historic premium against current revenue run rates, asking if the private market exuberance aligns with public market reality. Core risks and headwinds. Of course, any rigorous financial analysis requires a stress test of the core thesis, objectively evaluating the headwinds threatening this valuation. Systematically laying out the bear case reveals a few distinct threats. First, there's carrier disintermediation risk. Major carriers may launch their own self-serve SMB platforms to avoid being commoditized. Moreover, credit risk spikes as they expand capital solutions into Tier 2 through 4 cities, where roughly 90% of volume is cash on delivery. They also face heightened merchant churn risk, given the intense competition in their fast-growing checkout and SaaS lines. And looming over it all, their high-margin cross-border segment faces continuous geopolitical and tariff disruptions. Deep API integrations and over 250 ecosystem partners make Shiprocket an indispensable demand generation channel. But this brings us right back to that suspended vulnerability from earlier, the defensibility of the moat. Shiprocket's defense against carrier disintermediation is sheer, aggregated scale. By integrating so deeply, they have essentially made themselves an indispensable demand generation channel. Carriers simply cannot afford to cut off an aggregator that controls roughly 5% of India's entire e-commerce volume. Does this 1,617 crore offering represent a fair premium for the operating system of India's e-commerce future? Which leaves us with the ultimate consideration. Does this offering, priced at a premium valuation, represent a fair entry point? The data shows a massive operational turnaround and surging high-margin growth segments, for sure, but it is balanced against fierce competition and total reliance on third-party physical infrastructure. That is the fundamental calculation the market is going to have to make.